Michelle. Given headlines around private credit ranging from rapid asset growth to liquidity concerns, how should investors think about whether this is a temporary dislocation or more of a structural shift in the market?
What we are seeing in the private credit market doesn't appear to be structural shift in market. Instead, we believe this is cyclical stress within a structurally growing asset class, not a broken model. From a market structure perspective, there are several factors or tailwinds that are long term, and therefore we anticipate they are not likely to reverse course. The global financial crisis permanently caused U.S. banking retrenchment as a result of the reduced willingness of banks to hold certain corporate loans. The private credit market is mature, with large managers now scaled and able to compete against the banking market. The ability for middle market to enter the syndicated loan market and borrower and sponsors' need for customized loans, speed, certainty of execution. Finally, there is continued strong institutional demand, for example, with pensions and insurers that need yield and duration. All of these factors can lead you to believe that private credit is structurally embedded in the financial system and is not going away. At the same time, fragility is being exposed as a result of current market conditions or market cycle. Certain market cycle risks have surfaced that appear to be temporary in nature, in our opinion. Rapid AUM growth might cause weakening of underwriting or credit standards, compression of spreads, a liquidity mismatch in the market in which certain fund structures offer liquidity from an inherently illiquid portfolio. Despite the structures appearing to work, the mismatch seems to be causing visible stress in the market. Finally, there might be a delayed default cycle with rising default rates not yet visible in the market. We believe private credit remains an investable asset class.
So, given all of this, can you share what the key takeaways are for today's investor?
Manager selection is more important than ever. Ensure there's a focus on underwriting and portfolio management discipline. Understand vehicle structure and what that means in terms of liquidity. Ensure that structures meet the investor's liquidity needs. Finally, ensure diversification in terms of manager, credit, vintage, etc.
Thanks, Michelle. It was great to hear from you.
Thank you.